Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. The big pattern here is still the highlighted in dark blue Big Bear channel, currently 198 to 273, dating from the action from June to October 2022. This is a big old pattern and does not seem to directly impact the more recent action, as what we have seen now since August has been a market trapped by support and resistances, primarily stratified layers. Some of them seemed and still seem quite dense, such as the congestion at 234, the congestion here at 238 to 242 containing the March 2013 high at 240, plus the nearby short medium moving average currently 244, the February 2013 high at 247, the now flatlining medium moving average currently 241, followed by another congestion band between 250 to 255, this time with the 2013 high at 253 within it. After that, we had and still have another small congestion area between 258 to 260, with the 2011 high within it at 258, followed by a bit of a deserted area up to some of the most heavy looking congestion available overhead between 267 and 270. All those numbers are enough to be going on with for now. For now, until prices can break free of all these congestions, we will see an overall sideways market. And given how the upper trend line of the Big Bear channel does not cross the current market levels until the end of this year, we may be waiting for quite a bit until we see a significant move being made. So until we break out, we will still be within this bear channel, though this time the time left within it is gradually counting down. London UK feed wheat. The recovery rally higher from the mini reverse head and shoulders pattern formed roughly over the middle of May to the middle of June, petered out in late June, with prices turning back down. However, the decline halted ahead of the dip formed from the head of the reverse head and shoulders pattern. Looking again at this drop in early July, I am still not sure why prices went down that far or why they halted where they did, when it looked as if prices could easily drop to the June low or even the July 2021 low at 164. This failure to exploit the move lower led to the recovery back up at the start to middle of July, though the move up was a bit dramatic, even if it was the final part of a double bottom pattern. It was in this rise that prices met their first real obstacle overhead, and that's in the declining medium moving average, currently 186.85. This resistance managed to hesitate the market, but only for a short while as prices took off again up through the March 2013 high at 205.05, the June 2022 low at 206.5, and even the 2013 high at 215. Yet it was just above this congestion that the significant resistance of the declining long moving average, currently at 202.45, along with some nearby Fibonacci and other congestions, capped the rise. The subsequent fall led to the construction of one, possibly two patterns. The definitive small double top, Adam and Eve type, over the end of July, and an island top, though I am bending the rules for this island top idea a little bit. Okay, so now I wish to look at the bigger picture as it shows some interesting perspectives onto the recent action. To start with, the action here is obviously different on this daily chart when compared to other grain markets. I also mean the chance of a possible descending scallop pattern here is different than what has happened in the other grain markets. The opportunity for such a pattern forming in London feed wheat is still there, and the aberrations seen in this pattern, specifically the dip in late June and into early July, do not seem to be so influential on the overall market pattern. So where does this leave us now? The problem has been that, well, I suspected the descending scallop pattern idea might have been coming to completion a few weeks ago. But we've not seen that yet. Instead, we have seen what appears to be the supremacy of the neckline, currently at 182.05, of the original small May to June reverse head and shoulders bottom as a support. Until this neckline is dealt with, any idea of a descending scallop pattern is limited at best. The static nature of the market since mid-August to date prompts one question. What new factor will cause this market to move, either higher or lower? There are three potential answers to this. The medium moving average below, the rising short medium moving average overhead, which is separating away from the medium of moving average and thus giving some scope to move, and finally the descending long moving average above, which will not impact current levels till possibly sometime in November. These dynamic factors are seemingly the only ones right now that can cause a significant move, and I'll rather pay close attention to all these three. I would certainly favour it to pay close attention to all these three. I can only echo what I said many weeks ago, and I quote, "Until these roadblocks are removed, whichever one it is, and obviously be aware of false breaks, well, then we will, as we have seen this week, be heading nowhere."
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.